2012 has been a rewarding but yet a volatile year for Indian investors. So what's in store for Indian markets for the year 2013? Hope, despair or stability? Let's discuss that with a very special guest, someone who has seen many bull and bear market cycles and is one of the smartest money managers on D Street. Akash Prakash of Amansa, who joins me from Singapore. Akash, what a delight to have you back on ET Now. Thank you for joining us. Akash, I guess my introduction was the question in itself. After a volatile and a rewarding 2012, what's in store for us for 2013?
Yeah, I wish I knew. My sense is that, you're going to have a... It really depends on what the government and the finance minister do, from here, because a lot of expectations are now getting built around the budget and around the reform process in India. So I think if Delhi and the finance minister in specific can deliver on some of the promises and some of the expectations, I think the market has still some scope to rise a little bit more. But obviously the risks are greater now because people's expectations on India have gone up, changed quite a bit in the last 3 or 4 months. From before September, people had almost no expectation on the country, and there was a great deal of skepticism. Now people are very convinced that you're going to have a 6-month period of a very significant burst of reforms, and if that doesn't happen, then I think there will be disappointment. Also, I think from a broad market perspective, it's going to be more a stock-specific market because you are going to have a huge amount of paper coming out of India in the next 6 to 12 months, both government because of disinvestment, as well as the private sector. Already, there's almost a deal every second day already starting to happen in India. So there will be huge paper issuance. So I think to summarize, it will be a stock-specific market. I think there is upside if the government delivers on what they've been talking. But you should be very focused on what stocks you're buying, and be very aware that expectations are quite elevated now compared to 3 or 4 months ago.
Akash, so what to your mind really could be the next big trigger for Indian markets? Will it be news flow from Delhi? Will it be a rate cut, or it has to be a pickup in the investment cycle which will boost the earnings, which eventually will help Indian markets to propel higher?
Yeah. No, I think the investment cycle will take time, Nikunj, in the sense that, that's going to, by the time you actually see new projects getting announced and hitting the, hitting the floor, so to speak, there's going to be at least 12 to 18 months away. So that's going to be, so you'll have a situation where earnings will not be great for the next 2 quarters. They'll be okay, but the market, if it were to go up, will go up despite that, because I think what people are going to, the market will obviously discount what will happen over the next 6 to 12 months. So I think if they can, push ahead on this National Investment Board, create a more conducive environment for investment, clear certain high-profile projects, that's one important thing that people want to see. Obviously, I think movement on GST, movement on some of the bills in Parliament is critical. And I think the other big thing which is missing in India right now is, the participation of local investors. I think that the whole of 2012, even though the Indian market has delivered something like 25 or 27% in rupees, and vastly outperformed any other fixed income at least, it's still a market where retail investors are constantly redeeming. So, I think at some stage that has to reverse, and I think that when that reverses, that will give a far more powerful push to the domestic market, that if domestic investors actually start putting money back into equities. So I think it's not going to be an immediate reversal of the investment cycle. I think people have to feel better about the economy, about the whole procedural issues around setting up new projects in India. You'll have to see them deliver on reforms like movement on GST, movement on National Investment Board, movement on other bills in Parliament. And I think the third thing, as I said, is people have to feel more confident and hopefully see domestic investors coming back into the equity market.
Akash, but in the light of what is happening in Brazil, the fact that China is slowing down, if commodity prices they correct, it could be a problem for Russia. Do you think Indian markets are clearly standing out, and that is something which global investors will take notice of?
Yeah, I think, that is true. If you ask, people ask why has India got 21 or 22 billion dollars this year, even though on paper, things have been quite disappointing till very recently on the ground in India. I think it's what the point you made, which is that, the other parts are even worse. If you look at the so-called touted BRICS, Brazil has a lot of issues, economy growing at 1%. They have they have currency issues, they have political issues as well. China, people are still very nervous on the slowdown. Is it a soft landing, hard landing, leadership change? There are issues around China as well, earnings trajectory. And Russia, Putin has come in. Again, there are a lot of political issues of national, a whole bunch of stuff in Russia which is independent of around governance and stuff like that. So among these 4-5 large, emerging markets, I think India does stand out because, earnings, as I said, India, economic growth is accelerating, earnings growth will accelerate, interest rates will come down. There are not many markets in the world you can say that about, over the next 12 months that all these three things will happen. So India is benefiting from being probably the, less bad in a pretty bad, neighborhood, so to speak. But I think we have to deliver also. We just can't rely on the fact that, China looks bad and Brazil looks bad. I think there's a clear agenda Mr. Chidambaram has laid out. He's articulated that very, very clearly to investors, both locally and internationally. I think he will deliver. I hope he does, and I think he will. And I think, people are getting a sense that the Indian government is once again in control, regaining the initiative, is willing to move ahead and take some decisions. If they deliver on that, I think the market will do well, and and we're okay. My only point is your scope for disappointment is far less today than it was 3 or 4 months ago, because 3 or 4 months ago people were not expecting anything. Now people are expecting a lot, and you have to deliver.
Prakash, in the event of correction, where do you think Indian markets will find support? Like you indicated, the sentiment has changed, and clearly the current investment strategy is that go and buy this market on every decline.
Probably 50. Things go wrong. It depends how you define going wrong. If you define going wrong, let's say you paint a scenario that Delhi nothing happens. It's a very populist budget. That people, they can't push through the National Investment Board. There's no movement on GST. Nothing gets through Parliament. If that would happen, the market could fall 20% easily. I think you go back to 5,000 because, the move from 5,000 to 6,000 is largely based on the fact that people think that this government is back in control and that they're going to start moving and getting things, long pending decisions will get taken. If people once again start believing that, no, nothing's going to get taken, we're back to policy paralysis, I think you'll go all the way back to 5,000. So hopefully that doesn't happen. I think that's an extreme scenario. I don't think that's likely because I think they will deliver a lot more than that. But you could have a 20% correction if they do nothing.
Do you think the polarized nature of this market is changing? If I look at the Nifty 50 gainers, it's not HUL or ITC. It is Ultratech, JP Associates and IDFC.
Yeah, no, I think, in fact, I've written a couple of articles on this, arguing that, that trade is very, the so-called defensive consumption, rural consumer or FMCG type of trade, I think that trade is very, very late in the day. And I've said this and I continue to maintain this, that if the market does reasonably well next year, or if sentiment improves, those stocks will actually go down on an absolute basis because there's a lot of money hiding in these so-called defensive names. They're very expensive. They're over-owned. I think the scope for earnings disappointment is there in those stocks. And as and when people gain more confidence on the market, or they gain more confidence on the economy reviving and accelerating, I think you'll see people moving money out of these FMCG and so-called defensive names into more economically sensitive names, whether it be banks or manufacturing or capital goods or whatever. So I think that trade will happen if the market remains, even if the market remains where it is right now. I think you will see this rotation continue where money comes out of defensive names and goes into more economically sensitive names. I think that trade has already begun. It's in the early stage of that rotation, but I think it'll continue. And I think you will see a very different set of winners, like what you've seen already this year with Ultratech and IDFC. Those type of stocks will, I think, do better, continue doing better than the defensive names going forward. Take example of Mindtree. It's a small mid-cap IT company. They should do 80 to 85 rupees earnings per share this year. The stock is 650, 660, 8 times. Margins are organically will expand next year. And I think people, it's a 30% ROE business, free cash flow positive, good entrepreneurs.